crazy moon. Okay, we're gonna try to get this just right. I'm gonna move up all your. We might can get it how we want it. There we go. There we go. Okay. Just remember it's there. Try not to hit it. If you see it, stop blinking or. I did. And this is a different phone, so it looks a little different. That other one, sometimes it'll pop up that it's out of memory since I've got plenty of charge on that one. I'm going to use this one. Okay, so I know we're in the vicinity of 60 here. And see, this one will actually show my notes too. That other one won't show anything until I run the slideshow. So we were covering Form 8949 and Schedule D. And this is like stocks, sales of assets, that sort of thing. Remember, you don't have all these because this was a very, very heavy chapter on information and everything like that. So some of these are just for, writing down notes and everything. This is a good summary page. This is one of the last things we touched on. Schedule D summarizes capital gains and losses. And like I said, guys, I'm going to pull some real examples for Thursday. And we're going to do some returns with some of this in it. Tax returns, and you're going to see the Schedule D in its real form. You're going to see some real stock forms because what they put in there for dividends and interest and whatever the other one is in the Schedule B, I think is the other schedule, doesn't do it justice in here. It helps to have real ones. So I'm going to go try it in the next day or two, dig some real ones out and block out some of the pertinent information, but at least have some of the numbers so you guys can see that. And see how those go in real time. It'll make it so much more clearer for you. But yeah, Schedule D summarizes the gains and the losses. Part 1 is short term, part 2 is long term, and then it combines those and puts the losses on line 16. So this is just good to know if you should ever need it. The losses are on line 16. All of that will roll to the 1040. Short term and long term. Does anybody remember what's classified as a short term?
Less than a year, and long term 6 months. Short term?
I think short term is a year or
less.
I just did this over there, and I'm like, I told them I never get it right.
It's a year or less.
A year or less,
Long-term
and long term is more than a year. Yeah.
Yep.
And so here's the thing about the forms they bring in and the information they have. So, and I'll see if this is summarized. I was gonna see if it's over here. Okay, so basically, they're all laid out, and the basis, okay, on those forms, it's going to have the year of the sale, okay, date of the sale. It's going to have date of the purchase. It's going to have, and we may have already covered this, and it's on one of the forms, but it's going to have if it was short term or long term, and of course you can tell by the dates, okay, all that's laid out for you. Okay, all you have to do is data entry. Now, the basis, obviously, if you have a basis and then you bought it and then you sold it for less than what you bought it for, you're going to show a loss. If you gained something on the sale, so you got a good buy and you sold high and you got a good gain, that depends on what your basis was. Now, years ago, a lot of the holding companies and organizations that do a lot of these stocks did not report the basis. Now, a few years ago, the IRS kind of pinned down and said, hey, that's not really fair to some people that could show a loss. You really need to start reporting that basis, what they paid for it. So technically, legally, if someone comes in and they have a stock or they have something of that nature and it doesn't have their basis, if they can give it to us, we can technically put that in there. Okay? That is an honor system from them if they know what it is, if it's not reported. And it would literally say basis not reported. It's going to say on the form. Now, like I said, sometimes it behooves them to have it. If they don't, we just put it in and it falls where it falls. I don't know why you wouldn't want to try to have some idea of what you paid or sold or whatever, but some people don't. I mean, some people don't even know what's in their stuff. They're like, I don't know what this is. It just says IRS and bringing it in, And that's where, if we at least know enough to tell them, hey, this is what this is, because sometimes they don't even know that stuff's being sold. Like somebody else is doing this for them. They just know they're getting their forms. Maybe, if it was done months ago and something got put in their bank and they spent it, they may not even saw it, paid attention. I'm gonna get that all the time. They're like, I didn't even know I made money off that, or I didn't even know I was taxed on that, or, so we see that a lot. And so anytime we see things like that we think they're not sure of, it's definitely our job to explain it. We just want to be careful how much we explain because we're not financial advisors.
Right.
Okay. Like I told you guys before, I do have somebody, he's getting into some of it through his company he's going to start working with. So we do have other experts we can go to if there's ever any issues or we have any questions, but it was just us. We want to make sure that we're careful on that. The allowable loss reduces dollar for dollar their taxable income. If total net loss is more than the yearly limit, they can carry over an unused portion. All that's going to be determined with the rest of their income. So it's different person to person. Okay? Now, this loss is important because if you have someone that's had losses or had stocks or had some of these things we're talking about, if this is their first year here, we don't know if they have any of this kind of thing from previous unless they tell us. So I had a lady that came from Fayetteville because that store had closed, and she came in this year and she's like, well, I'm supposed to have some kind of rollover loss. And then some of the preparers were like, what is she talking about? Because they had not done the return yet. She was dropping it off. And I said, well, here's the thing. This is what's going on here. I could tell by her stuff, but we changed softwares. And I said, well, I know that gentleman at that office didn't use this software. I don't know what's going to roll over. I'll have to look. I don't know where it's going to be. It's new software. Who knows where it's going to show up in there, because sometimes things may be a little different software to software. So she did. We checked it. I think we ended up pulling her prior year. And she did have a loss, and we got it put in there and everything. And I think we did actually have to type it in there because it wasn't rolling in like it should. But anyway, just know they are allowed to roll over losses if anybody asks or mentions that or says, hey, I did something somewhere else and I have this loss I'm supposed to be, and that's usually how they word it. I have something I'm supposed to be able to use, It's, okay, sure. Because that's usually all they really know, because they kind of know what goes on with it, but just for like us too, for them it's been a year since they've looked at it or talked about it and that sort of thing. And sometimes people don't realize we're not intravenously connected to the IRS. We can't just find your stuff. Like, they think there's some portal, and if they went to H&R Block, well, y'all can just see everything. Like, that's truly, and it's not their fault. That's just what they think.
It barely happens in healthcare, so.
I know. So I'm like, okay, here's the deal. We can't, and they're making it more difficult. I mean, there used to be some things we could do. Even this summer, I was pulling things and doing certain things that I, had been doing them a certain way. The IRS has changed it again. And so those things are constantly changing every year of what the IRS is battening down on what we can do locally and see and whatever. So let's see. Taxable state and local income tax refunds. Okay, how many of you guys have heard of a state tax refund being taxed before?
Say that again.
A state tax refund being taxed. Okay, I kind of told y'all at the beginning of this lesson that they kind of put a bunch of different crazy stuff in here. So basically, and let me go to that for a minute. This one may or may not be in your packet. I think it is. 1099G, it stands for government payments. Okay, 1099G. And if you look here, unemployment can be reported on this, state and local tax refunds, agricultural payments, taxable grants. I've not really ever seen any of these come in. Okay, but these are the two main ones that are done on this G.
Yeah.
Is the unemployment and state and local tax refunds. Now, usually everyone in Arkansas gets one of these if they get a refund. They legally send it out to them. Do they really need it? Well, it depends. Okay, what it depends on, you only have to file this form and get taxed on that if you itemize on your federal return the year before. Okay, now let me show you, let me see if it'll, it may or may not show you this. So I'm going to show you that. So I'll explain it to you. It's not on the slide. Basically, we're going to get to what itemizing is. Okay? Yet again, do people always know if they for sure itemized or did some of those credits the year before or deductions? Sometimes they have no idea. They're like, I don't know, I just drop my stuff off with my people and they do it, Itemized form is the ones we're talking about use. We will go over it in depth, but if they itemize, they use like house interest, property taxes, charitable givings. Okay, there's a way that you can get a higher deduction in a certain spot that you guys will learn about coming soon. And if you use that the year before and you take those higher deductions, you are taxed on that form, on your refund for state. Okay? If they're clients of ours, we can go look it up and see. There's a way we can find out. If they're not a client, then kind of what I tell everybody is, well, look at what you've got in front of you. If those things fit on that itemized page, and they looks like they're going to itemize this year, there's a good chance they itemized last year. Okay, so you'll hear that word a lot. Itemized medical deductions was the other one. You'll hear that word a lot, itemized, but we will go over that. There's itemized and standard deduction, two different deductions. You either take one and straight down the board, the IRS gives us the amount every year, that's the amount you use. And then there's itemized, where you can bring all these different things in, and we look through those, and then we compare.
Oh, it makes sense because it has the word item in it.
Right.
Itemized.
Yep,
Cool.
itemized. It all itemizes it out. Now, the thing with that is that they've changed the way they itemize in the last few years, the things that can be on that form. And sometimes you can itemize on federal, or excuse me, you can itemize on state, but not on federal. The downside is you still have to put everything in the software to see if you're going to meet that itemized on state.
Okay.
So sometimes new preparers will be like, well, or they'll ask me, do I have to put all this in? I mean, they don't. I know what the amount is now that I've been doing returns. They don't have enough for federal. Well, the answer is yes, you have to put it in because you don't know if they made it on state. State's a little more difficult because there's all different things you can do with the state as far as filing status and helping them lower their tax rate and all that. So you don't know unless you put it in.
Okay.
And so that's it's always been my motto. I'm like, well, you also don't know what they're missing unless you put it in. If you put it in and they haven't given you any medical and they haven't given you, whatever other sections, well, that gives you an opportunity to ask them.
Right.
You don't know by looking at them if they had medical expenses last year till you ask them. Now, the caveat is we do, as of this year, should have to still ask them some medical questions, if not all of them. But years past, we had to ask if they had medical coverage. So then you did kind of know if they paid for it. If they said, no, I was on Medicaid, I didn't pay for anything, well, then you know they didn't have medical expenses, right? Don't ask them the same question 10 times. Clients don't like it, actually, because they think you don't listen if you ask them. So I've gotten that complaint before. I'm a habit of repeating questions. That's just the way I am. I double check, I double check. But sometimes if they remember you asked them that already, they think you're nervous, they think you know what you're doing. So we need to try to remember if we ask them already not to ask them again, just because that's how clients are, because they know, what you're asking and the flow and everything and how it's going. So that's a good thing too. By the time you get to that point, you know if they've got medical, you know some of those things. So you're already going to kind of have a gauge of whether they itemized. And so usually I go over this in P&P, but I was telling them kind of a way that I keep that straight is when they bring in their information, I usually divide it out. So I'll have their W-2s, 1090, anything that's actual, I call it like lower level kind of easy stuff, I'll put here. If it's like a small business or something crazy, I put that in another stack. If they've got charitables or anything that's going to go on those other pages, I'll put that in another stack.
Okay.
That way I've kind of got it divided out. And then the way I like to do it, I don't like highlighters. I try not to mark on any of the originals. But I will literally turn it over once I enter it in. And then I will just re-summarize it. Okay, we put in your Walmart W-2, your Cricket W-2, and we put in your hospital W-2 or whatever, Is that all the W-2s where you worked? That's all your W-2s, right? Because sometimes if you give them the amount later, they didn't add up the totals. It's like one thing to be like, okay, it looks like your income was $52,000. Well, that doesn't mean, that's not going to tell them if they forgot something, right? So I try to literally itemize back over, the names of the business and where they worked and whatever, and it's a good chance to double check yourself as you're talking about it. Okay, I've got that W2, that W2, and it'll help you kind of get some of those things that if you don't need it, you can put it aside too. Oh, well, we don't need this one. You don't have to file that. Don't worry about that. You just don't have to file it. It's not a rule that you have to, and then you move on to the next. So, alimony, we're not an alimony state. And I didn't tell this to them, but I think they know the difference. Child support is not alimony. Does everyone know that?
Yeah.
Alimony is more of a paid item. It's like a settlement when you get a divorce or what have you, split up. It's paid to someone. We're not an alimony state, so we don't really see this a lot. But if we did, it's on line 11 of Schedule 1. You may or may not have this in there, so you can take a note on it if you want to. all this changed kind of last year, so these are the updated information here. Child support payments are not alimony. Child support payments, if you make the payment, you do not get to deduct that. If you're receiving child support payments, you do not have to include them as income. Okay? The person that makes the payment pays tax on them. The person that receives child support does not have to claim it on their taxes. Okay? Unlike alimony, which alimony, if you pay it out, you get to deduct it, and alimony, if you receive it, you're taxed on it. And that changed last year, so that's new. For years, if you got a settlement of alimony and a divorce or what have you, you did not have to pay taxes on it, and now you do. You have to claim it as income. Okay? Because it's considered alimony maintenance and not because it's really paid to the spouse. So now you are taxed on alimony, but you are not taxed on child support. Likewise, if someone comes in just on that child support, just kind of looking here. Okay, you can have voluntary withholdings. So like you don't have to withhold, quote, for unemployment, Social Security benefits, most Social Security benefits, so that covers you there. And then dividends on Alaska natives. I've had this one time, but it was actually for Native American. It was a Native American type of distribution from a corporation. So I've only seen it once, but I have seen it. So just be mindful if you ever have anything like that come in. All of these are voluntary. That means they're not necessarily taxed when they put them on their form. So a lot of people don't realize unemployment, you have an option. You can tell them, oh, I don't want to be taxed when I get it paid out. But you have to reconcile it and pay taxes on it when you file it. Okay, so you do legally have to file it. It's just when you're actually getting it paid out, you can choose not to have taxes taken out on it. Which, remember, everybody's situation is different. If you're a married couple and your spouse is highly taxed on their income, that might be okay for you in your situation, but not everybody.
Mm-hmm.
Okay. Another thing you have to be careful on this is, can your situation change in the middle of the year? What if your spouse is doing most of the withholdings on their W-2? You were on unemployment part of the year and you guys get a divorce at the end of the year. You didn't hold out anything.
Mm-hmm.
If you didn't have any kiddos this year to claim and all you have is $10,000 in unemployment for 8 months, you're in trouble. You're going to be like, oh my goodness. No, you might be okay. But no, you just have to be careful in those situations. Another one that's not on here that we were talking about over there is gambling winnings. They were asking me, well, you know, what's kind of the rule of gambling winnings? And I said, I know that if you ask them at the casino, it's going to differ who you ask. There is a set rule. It may even be in another lesson. There used to be an actual amount, but then I noticed that at the level of the casino, if you don't request it to be held, taxes to be held out when you jackpot, sometimes they won't do it. Not our place to regulate it, but I've just seen it before. And what I do, especially in Arkansas, another thing I noticed on the actual, well, sometimes people forget too, they've gotten jackpots early in the year, and they'll be like, I didn't go to the casino. Why is your name on it? It's in your stuff. Had that happen last year. We have to be careful in Arkansas because obviously that's Oklahoma income.
Mm-hmm.
So they don't take out for Arkansas. So what I usually do, even states have kind of a level of income you have to have before you have to file. So I've kind of used as my general guideline, if it's a smaller jackpot and they only have 1 or 2 and they have nothing else for Oklahoma, I don't usually file it for Oklahoma. Reason being, they usually don't include the withholding number on there. I don't know why Oklahoma will do that to some of the casinos. Missouri does the same thing. They won't have the state ID number. So we can't file it if we don't have the state ID number. Now, if somebody came in and say they won like $8,000 at the casino, then we might look at maybe trying to have them call the casino, or we may try to call for them and get that ID number, because the higher up your income goes, the more likely the state is to come after you to pay taxes on it. So if I know it's a few thousand and they're probably not going to come after them, I don't have them file it. And I usually tell them, this is what we're doing, this is why we're doing it, and I notate the packet. Okay? That way if it ever comes up, I can say, well, remember we talked about it, you didn't have that information, their filing requirements a little higher than that normally for that state, and so we didn't put it on there. But we can, if you get a letter, come back in, we'll throw it on there, no big deal, and we'll have to file it for you. As you can see, if we know they have pretty large jackpots, we might want to go ahead and file it and not wait in that situation. I have someone that's already an Oklahoma resident, so it's already taxed on hers, but she made like $70,000 or $80,000 one year over there. Obviously, I'm not going to tell somebody to ignore that if it's not the state they're in. Like, let's double check and find out. It's definitely probably a filing requirement on that one. So that's kind of how we handle those. That kind of goes along with the income and withholdings and things, but we went over that with them. Key ideas, report your interest, interest on savings bonds, are taxable on federal only. A lot of this we've already talked about and you guys have taken notes on it. Report dividend income on your 1040. Schedule B is for interest and dividends. Capital gains, 1099 DIV. Schedule D also is capital gains. That's going to be stocks and sales of any kind of property. What else do we got? State and local tax refunds are included in taxable. Report your unemployment, and you can choose to have some types of things withheld. Unemployment compensation. So there's anything else in this one I want to go over. I don't think there is. Oh, classwork, which we're going to do tomorrow. Woo! Can't wait. Okay. It's going to be a lot of stuff in one. That's okay. Excuse me. Tomorrow for them, Thursday for you guys.
Like quiz, that was a quiz question.
That's right. When I say tomorrow for you, it just means the next time we meet. We never
Just trying to see if we were listening.
That's right. Okay. Let me see. I think I was going to go into chapter 7, not to confuse you, but chapter 6 is very minimal. It talks about that standard deduction, and I would rather teach those at the same time, or maybe touch on that while we're doing the return, because they're laid out nicely on a 1040. So I'm going to skip standard deduction for now, because I think 7 is good to go over first, because it's actual tax credits.
Okay.
And I just would rather get to some juicy stuff. So standard will probably go over before we do our practice. We'll touch on it briefly, and then that way we can deduct standard deduction when we do our first practice session. And then we'll work on some itemized ones later when we get into the itemized deductions. So that way you will have already seen the standard deduction. We'll go over credits. You will already seen credits. And then we'll probably do some simple practice later when we do itemizing and some of those other things as well. Okay. Like I said, guys, I didn't make any printouts for this, but I will print these out for Thursday so you have your notes. The basic thing, if you want to put this down, you can just put dependent tax credits, and we'll kind of go over each one of these. And as we go, you'll kind of see, I'll tell you, you will get a copy of this, so you don't have to necessarily copy this down. What you could put down is the 2. Now, if you want to do the 3, I hate that they do it this way, but this is how they do it. But let me get to
Refundable, non-refundable as the 2 is what you wanted to say.
yeah, let me get to the big screen so I can see it big. There are basically 2 types, non-refundable and refundable. But the reason they put American Opportunity Credit is we see a lot of those. That's the education credit that you get if your first 4 years of education. That's what it's called. And they made it super confusing, and instead of it being how it used to be, now it's a combination of both, which is just, it's crazy. I had to help somebody with this about a month ago, and it was kind of bonkers. But anyway, but I've had 2 or 3 questions on it the last month, so it is very important. But yeah, it's a little bit crazy the way it's calculated these days. So these are the 2 main types, non-refundable and refundable, and this is literally just telling you that that specific credit is both. It's just a little note there to kind of put in your cap. That one covers both. All the other ones, for the most part, are one or the other. Does that make sense? They just really want you to know that that one now is both. So let's think about this for a second. Non-refundable. So what does that mean if something's non-refundable?
Get nothing back.
Can't get it back, right? How do you think that's going to work? You can't get it back. What do you think that means in the terms of a tax credit? What would that mean? What do you think that would mean?
It's not deductible on your taxes.
Okay, it's not deductible on your taxes. That's kind of a good definition.
And you can't claim it in one area and get credit for it in another area.
Okay, that's kind of a good definition. Okay, what does refundable mean?
You
Get it back.
You can get it back.
Put it in and get it back.
Right, you can get it back. So the way to think of this is, okay, and this is just Amber speak, and it'll make more sense when we actually calculate them and when we go through some of these. Non-refundable literally means, I want to make sure I get this how I want it. If your tax liability is 0, you have nothing to apply that credit to.
Makes sense.
Okay, if tax liability is 0, okay, so let's just throw out a random credit. There's a credit, we don't cover it here because it's smaller credit, but I don't even know if it's still applicable. There used to be a credit for like fixing up your home. It was called like a random energy credit, okay? It was a non-refundable. Well, that meant if you were already at 0 and all your other credits had got you to 0, it's kind of a use it or lose it type thing. So that's a good way to put it. It's use it or lose it. If you're going through on this competency test and they give you this big scenario and they put on there tax liability 0, or you know by looking at the scenarios that you're getting close to 0, that's why you can't use it. I guarantee you that will be a couple of your questions. They'll lay out some scenarios and they'll say your tax liability was $500. Okay, that means you can only get that, and say that one of these random credits was worth $1,000. Well, how much can you use of the credit if you only have that 500 to get you to 0? You can only use 500 of that credit.
Yeah.
Most of them, you can't do anything else with that extra. And so that's where some of these credits, as we're going through, I'm glad they talk about them. I'm glad they show you these credits. One of the big ones they focus on in this chapter is, they call it dependent care. I like to title it daycare because it's easy to remember. But you can use dependent care in many ways. It can be elderly. It can be, I like to call it daycare because that's what we see the most is people come in with their daycare information. The biggest thing is, sometimes people that do the daycare, they're going to be already close to 0, so they don't even get to use it. It doesn't mean they didn't qualify. It just means they couldn't use it because they were already close to 0. Okay? They may have technically qualified to use $1,000 of a daycare credit, but they've only got $100 tax liability. Guess how much they're getting to use? $100. Okay? That's the biggest thing to learn when you're kind of reading through and when you're doing returns and you're doing them in real time, is knowing that rule right there will help you so much when you get into a tax return, even in the software. Knowing these things will help you catch mistakes. It'll help you explain it to them as you're looking through and you look at the different forms in the software. You'll be like, oh yeah, I remembered. Oh yeah, they spent this much, but I already know I'm not going to get to use that much because I know where they're at in their return. Okay? Refundable, on the other hand, means you can get it past that. So even if you're at 0, not owing anything for the year, okay, you can get it still past that. You can get a refundable credit to you, even if you're at that 0. Now sometimes, and this is what new preparers and new employees and a lot of people that maybe have only done their taxes or they know a little about taxes, it surprises them. There are some credits, okay, let's say for example your withholdings. Those are, I believe they're in the refundable section, I believe, on the 1040. You know, withholdings would probably be refundable because you paid those in, right? You can always get those back if you're at 0 because you're going to get it back because you paid it in, right? EIC credits that we've not gone over, those are refundable. That is a refundable credit that you didn't pay in. So that is basically coming out of the pot of taxpayer money, okay? You didn't pay that in, but you're going to be given a certain credit for each one of your kiddos. That's refundable, okay? And there's going to be some others we're going to talk about. But just so you kind of get that idea, sometimes refundable you didn't even pay in, okay? But you can get it if you're at 0, right? So non-refundable ones, they're disposable. You might lose them. You may qualify. Maybe you really spent that money on that energy efficient solar, whatever. That's great. But if you're at 0, you don't get to use it. Sorry. You know. So that's kind of the difference there in those two. Like I said, American Opportunity is just kind of in its own league, and it's super fun now to calculate, and oh my goodness, it's a mess. It's a pit. Okay. It's a booger. It's a little bit of a booger. It'll be okay. So the non-refundables they want to kind of tell us about, like I said, you will get this. I just really want you to kind of get the concept. Are going to be child tax credit, which I'm sure all of you've heard. Most people know if you're within a certain income guideline and you have a kiddo that you can claim on your taxes, there is thing like a child tax credit, okay? There's something new called an other dependent credit. That's new this year. This last year it was new, okay? Dependent care expenses, that's that daycare, taking care of someone credit we're talking about. Also includes elderly and disabled people that you pay to take care of as well. Lifetime learning credit, that's the other education credit, so it's still non-refundable, okay? And adoption credit that you probably won't see much of. I've done one of those in 10 years. They're a little bit of a booger too, so I'd probably have you have one of us do those. The other interesting thing about adoption credits is you can actually get the credit even if the adoption's not finalized. So you don't even have to have a kiddo in mind, but you can get a deduction for 5 years on what you spent on adoptions. So adoption credits are a little monster of their own. They're a whole lot of difference. Okay, so this is telling you, like I said, it's subtracted directly from your taxes, okay, which means it can only reduce your income to zero, income tax to zero, okay? So if that tax liability is zero and you don't owe anything for the year, okay, can't use them. Can't use them. Like I said, I will show you exactly when we do the practice as far as the 1040 and everything, where that is. But that's the big, big thing to remember. And if everybody takes notes, I can save some trees. No. I like to have them in nice boxes too, so you can see what you're doing. Okay, we're at 30 minutes. Okay, and then if you just want to write at the bottom, we will look at tomorrow when we do practice. You can see where those are actually at on the 1040. Refundable, okay? So this is kind of showing you some of the ones, and I don't think it goes over all of these in this chapter. I don't think I went through and went over all of them, but we will go over all of them before we're done. We've got EIC, so you can put EIC for short. That's Earned Income Credit. That's the really big child credit that a lot of people get that have little kiddos. Additional Child Tax Credit. And ACA. So that stands for Affordable Care Act. Okay? That's the net premium tax credit with the Affordable Care Act. Obamacare. Like if you had Obamacare, had ACA, had something to do the exchange, there's a chance that you can get a refundable credit because you overpaid for your insurance. Okay? That is one of those, we'll have to see what they do with it this year. I don't know if that's still going to be around. I know they're doing away with the mandate. I'm assuming as long as they have the exchange, they will still give credit if someone overpays. That could totally be changed up in the next year. Who knows? Okay? But that's the main ones that are refundable. Okay? It's treated like payments and added to your withholding. Okay? So it's treated like a payment to the client. And I think even on the 1040, it's worded as payments. In that section, it'll say payments. That's why they call it being overpaid. They're talking about clients, our clients, but they're talking about taxpayers overpaying the government. That's the way it's worded. I know that's weird, but that's kind of the way the IRS and they word it is you overpaid the government. That's how they word it. Okay? Like I said, guys, we'll look at all these on the actual 1040 and you'll see exactly where all of it goes. This is what I did like about the old 1040 is they were all so nice and pretty, and I could just, I could teach it in one class period, but it's not that cut and dry anymore. I wish it was. I hate all the extra schedules. They drive me crazy now. Any general questions about the difference in a refundable and a non-refundable? Obviously, to qualify for all these, there's going to be all different rules, all different things to them. Let's see. All of the following requirements must be satisfied to be eligible to claim the child and the dependent credit. Okay? The care is for one or more qualifying persons. Taxpayer and spouse have earned income for work. You don't have to write this down, guys. Some of these I'll print out. Taxpayer and spouse have earned income. Okay? So that's important, right? They both have to have earned income. 1 income. 2 income. 3 income. 4 income. 5 income. 6 income. 7 income. 8 income. 9 income. 10 income. 11 income. 12 income. 13 income. 14 income. 15 income. 16 income. 17 income. 18 income. 19 income. 20 income. 21 income. 22 income. 23 income. 24 income. 25 income. 26 income. 27 income. 28 income. 29 income. 30 income. 31 income. 32 income. 33 income. 34 income. 35 income. 36 income. 37 income. 38 income. 39 income. 40 income. 41 income. 42 income. 43 income. 44 income. 45 income. 46 income. 47 income. 48 income. 49 income. 50 income. 51 income. 52 income. 53 income. 54 income. 55 income. 56 income. 57 income. 58 income. 59 income. 60 income. 61 income. 62 income. 63 income This is the daycare credit, guys, okay?
Mhm.
They don't,
Say it.
not to be confused with something else, but child independent credit. So this is the daycare credit, okay? Like I said, it can be also considered, in some instances, possibly in with, dependent credit for taking care of someone disabled or paying for expenses in that nature, but mostly it's daycare for short. Care is for one or more persons. Taxpayer and spouse both have to have earned income. This is very important because if one of your spouses just stays at home and doesn't work, or if someone has a small business and shows a loss, they cannot take this credit. Okay? So you may have paid for daycare, that's fine. You're not going to get to deduct it if you showed a loss or you just put them in a couple times a week to go play tennis or whatever. Or go volunteer or whatever that may be. If you don't both show income, you cannot deduct it. Okay? Care is provided for qualifying persons so they can work or look for work. This is kind of a weird conundrum because some would say if you're filing a loss on a business, you did work, but it doesn't matter because I've been there. The other one that's supposed to also be exempt is if you're in school. So you're supposed to get the exemption if you put them in daycare if you're going to school. So there should be something on the form that will have you mark that if that's the case. Okay, all filing statuses are eligible except married filing separate, which we know that's the no-no anyway, but you cannot get this credit if you're married filing separate. Care provided cannot be for your spouse, the parent, child under age 19, or a dependent claim on your tax return. Okay, so what this is saying is the provider cannot be your spouse, a parent, another child, or a dependent. But if you have a grandmother that wants to claim income, say your mother-in-law or the grandmother babysat the kiddo that was 8 years old and you pay grandma $5,000 a year, if she's going to put that on her taxes, you can deduct that as a daycare credit. Okay? It just cannot be any of these watching the kiddo.
Okay.
That will be a question on your test probably, but I will give you guys a printout of this. Oh, and did you notice it says at the bottom,
All persons.
they have to be identified. They do have to be on the return. Okay? And this is just literally showing you, again, what qualifies under the age of 13. Pay close attention. Under 13. Not is 13, under 13.
Mm-hmm.
Okay? When the care was provided. Okay? So during the tax year, they have to be under 13, dependent, physically or mentally handicapped, or a spouse who is physically or mentally handicapped. Okay? That is super, super common sense. My bad. Okay. Qualifying person. Custodial parent can treat the child as a qualifying child even if he or she cannot claim the dependent exemption. Non-custodial cannot treat the child as a qualifying person even if he or she can claim the child. So what they're saying is, this is one of those things, you know, when you can break up dependents, which I don't know if y'all remember, we may or may have focused on it a lot, that there is 6 or 7 actual credits that can go for children when you're doing the tiebreaker rule. Somebody can claim them here, somebody gets other credits. This is one of those that cannot be split. You only can claim the dependent care credit if you're the custodial parent and you've paid for the daycare. Does that make sense? You do not get to claim the credit if you're non-custodial. Okay? Kind of stinks, I know, but you don't get to have that. Let's see, what is this? Child dependent care